Hello and welcome to New Future. In this video, I'm going to basically talk about everything you need to consider before you start investing, in the stock market particularly. It's so easy now, we've got these apps to almost instantly buy any stock we want. Where you're hearing these stories of people who have put 5 years of their savings into a YOLO bet, in a bet that they think is going to make them lots of money and they're going to be able to quadruple their money overnight. And that is the worst way to do it. And the chances of losing that money is so high, it's really not a great move. So in this video, I'm going to break down what things you should think about. And once this is done, I'm going to make future videos focusing on each one of these points that'll explain them in a bit more detail. So when you're going and investing yourself, you're going to be able to watch both this video and also have those videos that are coming up. And I'm breaking it into 4 different stages that you need to really think about and consider before even downloading any investment app. These are things that are important to know for the future, and they're going to make a huge difference moving forward. And once you have these in place, that's when you can start to invest. So you're not going randomly in and just buying any stock here or there willy-nilly. You're actually taking the time to think about what you're going to buy and why. So let's begin with our first point, and that is pick your investment strategy. So what does this mean? So there's 3 main investment strategies I'd like to mention today, and I'll talk about those in a bit more detail in a future video. So the first one is dividend investing. So you're buying companies purely for one reason. You want to get the passive income that's created by that company paying you a dividend. So if you don't know what a dividend is, it is basically money that's given to you. In Australia, it's usually either quarterly or 6 monthly. In the US, you can often get monthly or quarterly dividends. And these payments can be from anything from, let's say, about 2% to some cases all the way up to 8, 9, 10%. Now this has its benefits because you're picking companies that are effectively paying you to own their stock. So this can be seen as money for nothing really. You're saying, here, you can have my money for now as long as you keep paying me little bits for the ability to hold on to that money. And for some people, they're making quite a bit of money off the dividends, and some people are actually have enough to retire off dividends alone. So this is definitely an option for some people. However, it's probably not the best option by itself, and I'll explain that moving forward. Now we're going to move on to the next one, which is dividend growth investing. Now this is very similar to dividend investing. However, we're picking companies that not only have a dividend, but also are companies that are growing that dividend over time. And usually this means that that company will be growing over time. So this is an important aspect to consider. So you're not just picking a company that has a high dividend, because a dividend is not guaranteed forever. That company at any stage can say, nah, we're going to reduce the dividend or we're going to cut it altogether. So you want to pick a company that will have the dividend, but they're growing it over time. And the third one is a growth investor. You're not really caring if a company has a dividend or not. You're actually picking companies that look like they are growing over time. Good examples of this would be like the tech scene. Facebook, Google, Apple, these companies that are growing over time, and they look like, in 10 years' time, they're going to be, much bigger than they are now, and they're going to be worth a lot more than they're worth now. So you know that your money will be growing, that stock price will be growing, and your returns will be a lot more. So let's just quickly run through these again. We've got dividend investing, we've got growth investing, and we've got dividend growth investing, which fits in the middle. And that's sort of like a happy medium between the two. So you're caring more about the dividend growing over time, but part of that is you're actually picking companies that are growing over time and is a stable business. So that's kind of where I sit personally, is that dividend growth investing. I like the fact that they're giving me money, but you have to pick the right companies and do your right research, which in a future video, I'll explain exactly how to do that research. Let's move on to the next point, which is diversification. So diversification is an important factor, and it's one that is pretty much a must-do for people who are thinking long-term about their investment strategy. Diversification means you're buying different companies from different sectors. The most simplest way of doing this is by simply buying index funds, which an index fund is a pool of a handful of different companies all put into a single stock. So do your research and see what's available in your area, and also see what their fees are. Usually the fees aren't too much. A lot of the index funds for the most part are hands off, and so the fees aren't too much. And so the way that it works, for this example, let's say it's an index fund that has the top 200 companies in that particular market. So this means companies will automatically fall in and out of this as you go, but it's all automated, and they're going to make sure that at any one time it is always the most valuable companies in any particular market. So that means if you do own one stock, that one particular stock is made up of little pieces of each one of those companies, but your money is spread out in micro amounts between all of those 200 companies. And there's different ones. Some can be the top 100, the top 200, 300, 500, and so on. So it's really just doing your research and looking at how they've done over time and picking the right ones that you think are going to do the best. If you'd like to be more hands-on, then you can buy particular shares in particular companies. And so there's a bit more involved with that. And again, I'll be going through some of that in a future video, but let's run through some of this now. So the main thing you want to do is look at different sectors. All companies will fall into a particular sector. For example, let's go through some of these. It could be travel, it could be retail, it could be tech, just to name a few. Here's a list of a bunch of other different sectors that are around. So what I would focus on doing is making sure that if you're going to go and buy different stocks yourself, that you are actually buying shares in different companies for as many different sectors as possible. For example, you might start with one in retail or one in tech, and then you might move on to buy one in travel, and then buy one in education. You're going to buy into as many of these sectors as possible. So why are you doing this? Why do we care about what sector it fits into? Well, because as we can see, especially with 2020, we can see that some sectors are hit worse than others, depending on what's going on in the world. For example, in 2020, if you were to own travel stock or even some retail stock, some of these have plummeted and are worth a lot less than they were in 2019. However, tech companies, a lot of those are actually worth so much more than originally were. So you can see that different sectors are hit differently depending on what's going on in the world. So if you can own as many of these different sectors as possible, you're hedging your bets. If one sector goes down for whatever reason, because of the state of the world we live in at that particular time, at least you've got some other sectors that are hopefully in a better position than that particular one would be. So that's why it's always best not to go all in with all of your money on one particular stock. Spread it out over as many as you can. When I started, I just put $1,000 into each particular company that I'd prefer and made sure that that was diversified. So it was in different sectors. Let's move on to the next point. The next one is do your research, do your analysis. So what do I mean by this? There's two kinds of analysis. There is quantitative and there's qualitative. And they work slightly different, but you have to do both of these before buying any company to make sure that you're doing your best chance of buying companies that are going to go up over time. So let's start with quantitative. Now, there's a lot of different factors involved with quantitative, and it is quite an art to understand these. I'm going to have a particular video explaining each one of these soon, that explains what's involved with quantitative and qualitative, and dive in deep onto what you should consider before moving on. And so what this basically is all the numbers behind it. Is that company doing well? For instance, if you're after dividends, do they pay a good dividend? Is it not too high, not too low? You don't want to go too high because they might be giving too much of their money out and not growing enough. But you also, in some cases, you want to see that residual income coming. So you want to buy one that has it. You want to make sure that their numbers and their company is growing over time. And you can see that their income is also growing over time. Do their numbers stack up? Watch out for my future video that'll explain this in a lot more detail, where I'll actually break down exactly what you need to consider, because there is a lot of words and a lot of things, and I don't want to overwhelm you today. So we'll leave it at that, but we'll move on to qualitative. We now want to look at all the other factors. Is it a company that everyone really likes and actually has a good PR? If you've got a company that's in the middle of, a media frenzy, you want to try and stay away from anything that could make the stock go down in price. And usually the best way of that happening is if it's involved with some sort of scandal or something goes wrong, that will bring the stock price plummeting down. So you want to try and pick companies that are simple and there isn't too much politics going on with the people who are running it. And so that's another part of qualitative, is that you also want to make sure the people who are running it know what they're doing. Are they founders of that company, or have they shown they're actually great at steering the ship of the company, and that you think that they're going to be able to grow this company in the future? And the other factor which qualitative falls into is, are you happy with this company personally? Do you believe in this company? And do you believe in their values and ethics? Because that is a part of it. If you're going to buy a company, you want to believe in that company. Because if you're going to own this company for 10, 20, 30 years, you want to make sure that you are happy with the direction that company is, what they do, their ethics, do their values match your values, and all of that other stuff. It's important that you're buying companies that you believe in. And that brings us to the very last point. That is, think long term. Investing your own hard-earned money should not be understated. And if you listen to all of the news lately, people sort of devalue the value of the money that you own. You worked hard for that money. And so you want to give your best chance of growing this money. But the point is that you're going to grow this over time. It's not an instant cash. You jump on the bandwagon, and a lot of people are going to lose money fast if you keep jumping on the hype stock or the meme stocks of the time. You want to buy companies that you believe in, you've done your research, you're buying into different sectors, and you've picked your strategy. And as long as you're doing these things and you've got a long-term goal involved, then it's really, really hard to lose money over time. So this means not looking at the stocks every day, and if it goes down, you freak out, that's it, I'm taking my money out, and you take it out and it's all over. You want to keep it in there. On the bad days, on the good days, you leave it in there, because even though it goes up and down like the weather, over time, it is gradually growing. And you can see this on any chart. If you go and look at any stock, any index fund, or anyone's portfolio, hopefully, if they've picked the right companies, and you look at it in a 5-year timeline, you will see that growth is going up over time. And so that's the important thing, is that yes, it'll fluctuate, it'll go up and down, but if you've bought the right companies, it will grow over time. So that gives you just the first things to consider. So make sure you are doing your investment strategies, you're diversified, you're doing your analysis in both qualitative and quantitative, and you're thinking long term. So as I said, I'm going to make videos on each one of these points in more detail, but for now we'll leave it there. If you found this, well done, because I've only just made this channel and no one's actually watching it. So if you do find it, please subscribe, but also share it with your friends, because I'd really like to see if I can make this channel into something. At the moment it's just me listening to them. So it'll be great if you can get it out there. And I'll see you in the next one.